What's up, friends? It's Lauren, MP broker at MP Realty. I just posted a super detailed blog post with a current update on the San Diego real estate market and forecasts for the rest of the year and going into next year. So I just wanted to give you a quick overview of that post. You can click the link to get into all the nitty-gritty data. You know I'm nerdy about data, but here's in general what's been going on this year so far and what I think we can expect for the rest of the year. So the year started out just basically the exact same as the last 2 years, just completely insane. Mortgage rates were still at 3.25%, and you'd be lucky if you can get a call back from a listing agent, let alone get in time to write an offer. I personally remember writing text messages to listing agents saying, hey, would a $50,000 over asking offer be competitive? And I wouldn't even get a response. So it was, a pretty brutal market still continuing, and a lot of buyers are feeling fatigue. And it pretty much stayed that way as we got in the first few months of the year into March and April. A lot of buyers started dropping out of the market, and during that time, interest rates did start to creep up. The Federal Reserve started taking some moves to increase the short-term borrowing rate because they were concerned about the inflation. At the time, they kept saying this is transitory, it's not a big deal, nobody worry. But they were taking action just to hedge against it in the meantime, and the mortgage companies started getting a little bit nervous about inflation. So inflation is the number one thing that drives mortgage rates, and when inflation goes up, mortgage companies get worried that people are not going to be able to pay their mortgages because everything costs more, and so they start raising rates to hedge against that risk. So by the time that it became painfully clear that mortgage rate or that interest inflation is actually a huge problem, was around the end of May, beginning of June. And when they actually came out with that inflation report saying that inflation was at over 9%, mortgage rates went through the roof to above 6%, and that just put a major brakes on the market. Affordability is a challenge. Even at the 5% mark when we were around May, and actually where we're back to right now, buyers have lost hundreds of thousands of dollars of buying power in our median price points in San Diego. Our median price point right now is $905,000 for a detached house. And the difference between 3.25 and 5.25, where we're at right now, it equals, over $100,000 in buying power. So June, though, was a complete shock to the market with rates going over 6%. I actually had some clients who were writing an offer where they'd gone and looked at the house on a Thursday. Rates were at 5.25%. They decided to write the offer on Monday, checked with the lender. Rates had gone up a full percentage point over the weekend. They were originally going to write an offer for $925, and on Monday, at the new rate of 6.25%, that same monthly payment would only equal a purchase price of $875. So they lost $50,000 in buying power over the weekend. So June completely shocked the market. Put the brakes on the market. And in the meantime, while all of this was happening, we finally have been starting to see some additional inventory come on the market, which is great because that's what we need. The lack of inventory is one of the main things, that and the super low interest rates, that has been driving the market completely insane, which is too much demand, too little inventory over the last 2 years. So we've been seeing more inventory, and then all of a sudden a super big halt in demand in June. And now all of a sudden sellers are looking around and saying, oh my gosh, what is going on? They're having to reduce their prices. We're seeing a lot of price reductions. Seeing multiple homes that are model matches that are having to reduce their price over $100,000 less than the most recent sale, which was within the last couple of months. So there is a little bit of a correction happening. And, at the same time, buyers are paying less for their, the price of the home, but the mortgage rates are higher. So they're still paying about the same amount, in their terms of their monthly payment, which I always advise my buyers, just focus on the monthly payment, make sure that's something you can afford. Don't worry about the purchase price of the home. So rates have settled back down. The mortgage companies are feeling a little bit more confident that the Fed is taking decisive action to curb inflation. So rates have settled back down to the low 5%. The demand in the market has picked back up, and it's sort of keeping pace with supply now. And they're, so it's staying pretty even. We're not gaining any additional supply. We're not losing any additional supply. We have about 2.5 months of supply in terms of the absorption rate. That's how we determine if it's a buyer or a seller's market. So we say the absorption rate is how long would it take it to sell out all the inventory that's on the market right now if no additional inventory came to the market. And in rule of thumb, anything under 90 days is a seller's market. Anything between 90 days and 120 days is a balanced market. And 120 days or more is a buyer's market. So right now we're at about 73 days to sell out all the inventory. Still a slight seller's market, but we're getting closer to that balanced market that we've been wanting to see. And I honestly think it's a good thing for buyers and sellers to be in a more balanced market. This means that homes are taking longer to sell. They're taking at least a couple weeks to sell, maybe longer. And, sellers need to be really realistic about their price points right now. The peak has come and gone. And they're not getting, it's not the kind of market where buyers are throwing an extra $100,000, $200,000 at a listing just to get it done at a 2.5% interest rate. Just not going to happen anymore. So sellers need to be very cognizant of not even relying on the sale data from a couple months ago and pricing their homes to be competitive against the current active homes that are their competition. For buyers, a lot of buyers are sitting on the fence and they're waiting and hoping for a housing crash, but it's not going to happen in San Diego. We're historically have such high demand. There's still a lot of cash in San Diego. Investors know that they can keep investing in multi-unit properties or duplexes or homes with ADUs, and the rents are going to keep going up. So, demand is not going to go down so much. And I don't think that we're going to get like twice as much supply all of a sudden out of nowhere to create an actual buyer's market. But I do think that we may be heading into a little bit more of a balanced market if we can continue to add the inventory that we've been seeing. So my advice for buyers is get yourself ready, get yourself pre-approved, start looking and watching the market. Right now, through the end of the year and probably before we go into next spring is going to be your best opportunity to get a good deal on a house. And what we're hearing from all of my lenders and what makes sense historically based on the data is as the Fed gets inflation under control, rates are going to go down. And historically, if we go into a recession or if we're already in a recession and we keep going through it, mortgage rates, historically, every time we go through a recession, mortgage rates go down. So most likely, the experts are saying we're going to see rates go down again to the low 4% as we go into and get through this recession that everybody says we're going through. So that, of course, is going to continue to drive demand. And we're going to really need to hope that we see that continued increase in supply. Right now, we're at about 4,800 housing units in all of San Diego that's for sale. About 1,900 went into escrow in the last 30 days. So, they are getting eaten up pretty quickly. And if rates go down again, as we go through the winter time and we deal with this recession, demand is going to stay strong. So I would say if you're thinking about buying in the next few years, I think it's going to pick up again in the springtime next year. So get ready to do it. It's always the best time to buy anyway during the fall, winter, holiday season when the buyers drop out of the market. And if you're thinking of selling, just be really realistic. Hire an amazing agent to help you market your property extensively and beautifully, price it right, and be patient. It's not going to sell in the first weekend. You're not going to get 10 offers. You're going to get a couple offers if you do everything right within the first few weeks, and then you get to pick a really good one. And if you're in no rush to sell, I would say you're in really good position to just wait until the springtime. I think things will continue to pick up. It'll be a hot market in the spring of next year, but you definitely want to listen to your agent about any repairs or renovations that you need to do and get those going now because, of course, we still have supply chain issues all over the place. Renovations are taking forever, and you do want to position yourself to be the most attractive option on the market. So that's what's going on. Check out the blog post for a little bit more detail, and please let me know if I can help you. I would love to set up a strategy session for you and help you achieve your goals going into the next year. Have a good one. Bye.